Hi, everyone. This is Tim Melvin of the Tim Melvin Deep Value Report and Banking on Profits, coming to you once again from what looks to be an overcast, probably thunderstormy kind of day down here in Central Florida. Great day for catching up with a good book and possibly a little late afternoon nap. Anyway, the market's coming in. It's at new all-time highs, up 1.25% for the week. The intriguing thing, of course, is the stocks are going up in anticipation of a better economy. Bond yields are still falling. As the bond market is not anticipating such a wonderful, rosy near-term future. Anyway, the reasons I've heard cited this week, talking to folks around Wall Street for stocks going up, is there were no new geopolitical events this week. Apparently, it is a very bullish thing if nobody actually invades another nation for a 7-day period. It's gotten that rough and rocky out there, fairly quiet in the Ukraine. Russia appears to be pulling their troops back from the borders, and that's an excellent sign. So maybe that'll all play out without roiling and boiling the European markets. Of course, there's been some M&A activity, and the one that everybody's been pointing to, there's actually a little bit of a fight now for Hillshire Brands. So that's generating some M&A news, and that's always a plus for the stock market when M&A activity picks up. However, I will note that all the private equity guys that have spoken in public recently, guys from Colbert Kravis, Leon Black from Apollo, have pointed out, and David Rubenstein of Carlyle most notably said that the valuation levels these deals are being done at is actually quite frothy and very high, and they would expect multiples to pull back. That would be not so good for the stock market, I assume. The big reason, of course, is everybody expects the ECB, the European Central Bank, to cut rates and take other stimulus actions when they meet later this week. As David Tepper pointed out, if they don't, it's going to be very problematic for global stock markets. The ECB seems to have tipped their hand, so we do expect to see some positive action out of them. What nobody talked about as a reason for stock prices to keep going higher is earnings. Okay, we're pretty much done earnings season now. We've got 2.1% blended growth quarter over quarter, which is not bad. And again, there's that anemic 1.85% revenue growth. Oh, that's better than the last few quarters. Lots of negative forward guidance. About 75% of the companies in the S&P 500 that gave guidance issued negative guidance for the rest of the year. It was only 25% said, hey, things are going to get better. So we'll see how that plays out, because the optimistic estimates for the next couple of quarters are very optimistic for S&P 500 earnings. So we'll have to see how that plays out with all this negative guidance coming in. Buybacks continue to play just a huge part in the earnings picture. Once again, everybody's playing this quarterly dance. They're using their corporate cash that's been piling up on the balance sheets to buy back stock. In fact, they bought back $158 billion, which is the most since 2007, before the credit crisis. That definitely has helped improve earnings per share, but we're still not really seeing the type of real revenue growth and profit growth that I think justifies where the market is currently priced. But then again, what do I know? Anyway, the stock market really shook off. They didn't care about the GDP contraction during the week. They probably shouldn't, since, as we've discussed, those numbers are rarely correlated. And the GDP report's not usually that predictive of stock prices. But it was an unexpected setback for the U.S. economy. The bond market has certainly taken notice. Lots of pundits have lots of different reasons. The fact that yields have dropped in Germany, so people are flocking to the U.S. to pick up 50 or 60 basis points. A short squeeze in Treasury, lack of available paper. But I think the real reason that the bond market is falling is the economy is not as good as everybody thought it was coming into 2014. We still have a lot further to go to get to what I would call a robust economy that's creating good, high-paying, full-time jobs. We're not there yet. I think the housing market's also noticing that, the bond market's noticing that we're not getting the lift out of the housing market that we had anticipated, and we're probably not going to going forward. Anyway, interestingly, this week, as we went through the weekend newspapers and magazines, Jason Zweig and Mark Holbert, two guys I have a lot of respect for, both came out and warned that investors need to temper their expectations of returns. Again, we had that nice 30% year last year in many of the indexes. Everybody's right back in there, just like they were in 1999, just like they were in 2007, expecting the stock market to be a slot machine that pays off at 15 to 20% a year, every year, just by throwing the money in a mutual fund or picking the hot, popular stocks. Does not work that way. However, equally interesting was Michael Hartnett of Bank of America Merrill Lynch. He's looking at all this and he thinks, people's expectations are ramped a little bit too high, but the fall of volatility and, of course, falling global interest rates could lead to a summer of what he called irrational exuberance, stealing the phrase from former Fed Chairman Alan Greenspan. The central banks have their foot on the gas pedal. The economies are still weak around the world. There's high unemployment. They're going to try to gas this thing with as much stimulus as they can possibly give it. That, combined with low interest rates, could provide us with a flood of liquidity that just drives stock prices dramatically higher over the next several months as investors and traders ride the wave of liquidity. We've seen that before. The central banks are going to stay in expansion mode. That could fuel that. By the way, that's the scenario that hurts the most possible people. Okay, hedge funds and large traders have been fighting the S&P advance all the way up. The public's just really coming back into the stock market. So if we get that kind of irrational exuberance and just a runaway rally, money will be sucked into this thing just as it finally tops out late in the summer. These irrational exuberance periods, as you may recall, don't really last that long. That is actually the scenario that could cause the most pain on Wall Street, so don't be shocked at if it plays out exactly that way. Now, today I want to talk about something that we've talked about in the past. I'm frankly confused why everybody and their brother is not using this strategy, because day-to-day short-term moves in the market have very little impact on it, and over time it's just been wildly profitable. Everybody from Peter Lynch to Seth Klarman to the guy that wrote the Wealthy Barber books all have been involved in what's known as mutual thrift conversions. This is simply when a mutual savings and banking institution converts to a stockholder-owned institution. It's an incredibly profitable situation, and I have no idea. We feature a lot of them in the Banking on Profits newsletter. No idea why everybody's not doing this. Anyway, taking a look, if you go through investors' portfolios like Michael Price, owns several thrift conversions. All of the bigger bank stock activists like PL Capital, Lawrence Sideman, and Joseph Stilwell all have lots of these things in their portfolio. So they make money over time, lots of money. Recently on the website Beyond Proxy, there was an article on thrift conversions. I found it real interesting. You need to go find it. It's by a fellow named Perry Pazrica. It's on beyondproxy.com. It goes through exactly what happens in the thrift conversion process, even throws a couple of ideas out there. I will tell you, I've looked at all four. I like all four. They're kind of small, but you could do a lot worse with your money than buying it. Anyway, to walk through this process a little bit, when a mutual holding company, mutual thrift, converts to a stockholder institution, there's two ways. One's the standard conversion. So here we have a $100 million institution, $100 million of equity institution, and they're going to go from mutual to stockholder owned. So they're going to do an IPO. They're going to do 1 million shares, 10 million shares at $10 a share. So they're going to price this thing at 10, but they're going to sell the shares that are on their books to the public, okay? Creating 10 million shares, but they bought another 100 million in on top of the existing 100 million of equity. So the shares that you're buying on the IPO for 10 are now actually have a book value of 20. Usually those first couple of days trading, they'll settle around $11.50, $12 a share. Very profitable for those depositors and lucky individuals that got in on the IPO. Not a bad deal for those of us who are buying at 60% of book value at $12 of a $20 asset out of what is usually a very clean, conservative financial institution. So we track those very carefully. We're always looking to get in as soon as possible after that initial IPO as we can, when this thing is trading at 60, 70% of tangible book value with almost non-existent, non-performing loans. And of course, now they're awash in excess capital. Now, the other process is the one that they really talk about in this article on Beyond Proxy, and that is when the mutual holding company, it's already some stock out there, but the majority of it's owned by the mutual holding company. Now, what happens here is you're going to have a $10 million bank, let's say, 10 million shares, trading at $15 a share for $150 million market cap, 100 million of equity. Looks like the thing's trading at 150% of book value, but those shares owned by the mutual holding company, they're basically treasury stock. Nothing happens to them unless they're eventually resold to the public. So let's see what happens when they go through the second step of the conversion process. Remember, all the financial services, reporting services show this thing at 150% of tangible book value, right? Trading at $150 million market cap, $100 million of equity. Mutual holding company owns half the shares in my example. So now they're going to come out and they're going to sell their shares for $15, bringing in another 75 million in capital. So now you still have 10 million shares out there, but they're all owned by the public now. The MHC has folded up. It doesn't exist. It's a stockholder-owned bank. The book value of these shares is now 10 million shares, 175 million in equity. It's $17.50. So it looked like it was 150% of book value. It's actually trading at a pretty good discount to tangible book value. So they go through the math on a lot of these first step conversions. It's in the report. It's worth your time to go look it up. More importantly, this should be a key part of your long-term investment strategy. I don't care if you're an action junkie or you're just wed to your system or you don't like long-term investing. I really don't know what your reason for not applying this strategy is, but over 4 or 5 years, and there's lots of these out there. There's going to be more coming, 4, 5, 6 deals every year of either initial or mutual holding conversions. It will be for an extended period of time in here. Unless you're allergic to money, you should be buying the new IPOs, and you should also be going back and looking at those over the last 4 or 5 years that have not been taken over yet and adding those to their portfolio. You need help doing that? We've got a newsletter that specializes in looking for safe and cheap bank stocks, and we have a ton of these recently converted thrifts in that portfolio. So anyway, coming up this week as we look around, Orioles are playing horrible baseball, 4-6 over the last 10 games. Our pitching staff is just absolutely horrid. We are 26th out of the 30 Major League Baseball teams in ERA and 27th as far as teams batting average against us. We're doing great in hitting. We're 6th in the major leagues in hitting. We're putting runs up, well, except for this past week when we couldn't seem to actually buy too terribly many runs. Got a game with Houston today. Hopefully we can split that road series. Then we're off to Arlington to play Texas, and the Oakland A's come in to fill out the week. So tough week for the Orioles. Hopefully the pitching can settle down. We can continue to put runs up once again and get competitive in the American League East. Now, if you're a book lover like I am, this is a huge week for books. Jeff Sherrard's new release, Smoke at Dawn, one of his new Civil War books, is going to be out. He follows in his father's footsteps. Of course, Michael Sherrard wrote Gods and Generals. This is just a fabulous writer, very well-researched historical fiction. Always look forward to his new stuff. Yeah, Stephen King has a new novel out, Mr. Mercedes, this week. That's been pretty widely anticipated. The only real business book that I see on the calendar is Steve Forbes has a new book out on why we need to go back to hard money and that the destruction of the dollar threatens the global economy. I think he does one of these every 2 or 3 years or so. It might be an interesting read. I'm not really too much of a hard money guy, but if you like hard money, that would be a good one. Alan First has a new World War II spy novel, Midnight in Europe, coming out. If you're a Dean Koontz fan, he has a new book coming out. And the neatest book coming out this week, it's out on Tuesday, it's called Face Off. This is a collection and collaboration among a bunch of different authors, Lee Child, John Sandiford, Jeffrey Deaver, just a whole bunch of other well-known mystery writers, and they're going to put each other's characters in a series of different stories. So these are always fun, and there's like 15 writers involved in this project. Should be a lot of fun, great beach, pool read type of thing. So looking forward to that. If you're a mystery fan, you probably want to pick that one up. I think it's only on Kindle, if I'm not mistaken. Anyway, busy economic news week this week. We've got the ISM on Monday. We'll see auto sales this week. Of course, the Beige book is out later in the week, so we can spend a lot of time dissecting and trying to figure out what they meant by every phrase and why they put that comma here and that period over there. Don't expect any real surprises. They'll show a slowly improving economy with some regions stronger than others, but no reason to stop the pace of tapering. The critical meeting this week is that European Central Bank meeting. It'll be a benign positive. Let's say if they do in fact cut rates, take stimulus measures. It's a huge negative if for some reason they were to do nothing. That could create some serious panic selling, and that will spill over into the U.S. markets. One of the interesting things going on this week is both President Obama and Vladimir Putin are meeting with the French President Hollande later in the week. Separate meetings, of course, but it'll be interesting to see what, if anything, is reported out of those meetings. That's going to be some interesting discussions. I'd love to be a fly on the wall for those. Long-term implications of it, we won't know for quite some time. But anyway, that's the week ahead. Should be interesting. Always plenty of stuff to move the markets around. And we'll be watching carefully for a chance to snap up some safe and cheap stocks. Anyway, this is Tim Melvin down here on an overcast day in Central Florida, and we will talk to you next week.